Hello, everyone, and welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Back on the program with us today is Peter Schiff, CEO of Euro Pacific Capital. Peter, welcome back to the program.
Well, thanks for having me back on.
I just returned from a long weekend in Mexico attending a conference where you were a keynote speaker. You gave a very strong presentation about the economy for the attendees and also participated in some panel discussions. Gold stocks were a topic you touched on, and in particular, how contrarian investing works. You said it takes a lot of patience, especially on the front end of your investing, and the way you explained this was very intuitive. Can you touch on what makes an investment contrarian and how that works?
Well, a contrarian is going against the crowd by definition, and so when you're doing something that nobody else is doing, let's say you think a stock is cheap that nobody else wants to buy, it's likely, to continue to stay cheap or get cheaper even after you recognize the value, because by definition, if everybody wants to sell something and there's not that many buyers, the price can go down. But you have to have the courage of your convictions and understand that returns don't have to be front-end loaded, that sometimes you have to sit on a position for years before it works out. But then when you look backwards at your annualized rate of return, it ends up being quite good. And that's the reward for being patient. A lot of people who are less patient, they need to get that immediate gratification. They want to buy something and have it go up right away. Generally, the only time you can do that is if you're buying something that's already going up because other people are buying it. But by definition, it's most likely expensive. And it doesn't mean it can't get more expensive, but then it collapses. And a lot of times, people who chase short-term performance end up losing money in the long run. And it's long-term performance that counts. That old Kenny Rogers song about playing poker, you don't count your chips while you're still sitting at the table, because it doesn't matter if you got a big stack if you go home broke. My concern is how many chips I have when the game ends.
That's a good point. And on the point of contrarian investing, I know that gold stocks and the precious metals are something you're looking very keenly at. Is there anything else, call it a stock market or an asset class, that you're seeing as a very strong contrarian play right now?
Yeah, well, not only is gold stocks a contrarian play, but a lot of the foreign currencies are contrarian plays. The Australian dollar, the Norwegian krona, the Canadian dollar, even the euro. The way you make money is try to find a trade or a thesis that everybody is betting on, and then try to see if it's correct. And if it's not, then you just got to bet against that trade. You got to take the other side. That's what happened with the mortgage market. Everybody was convinced that real estate prices can only go up, and they were all wrong. And there was a way to profit by betting against that. And you have the same situation today. You have everybody convinced the U.S. economy is sound, the Fed's going to raise rates, and as a result of that, they've already bid up the dollar. So there's not a lot of risk in shorting the dollar right now, because even if the Fed does raise rates, which I think is unlikely, that's already been built into the trade. I mean, people have already bought in anticipation of that happening, and so you could end up getting a buy the rumor, sell the fact. But if the Fed doesn't raise rates or launches QE4, which I think is ultimately going to happen, then you have a crash in the dollar, because everybody is expecting the opposite of that. And when they all figure out at the same time how wrong they are, the market will react very violently and very, very quickly.
And speaking about the dollar's actually started to come off the last couple of weeks. It looks like it might be forming some type of a topping pattern. How does that play into the fact that the market has priced in these rate hikes? Does that mean the market is starting to not believe the Fed's bullshit and things might be pushed back even further now?
Well, I think they still believe the Fed, but they also are listening to what they're saying, and based on that, they are pushing back their rate forecast as far as when the first rate hike will occur, and then how quickly the Fed will follow up on the first move with subsequent moves and the magnitude of those moves. And people are basically dialing back their expectations, but they still believe the Fed. I mean, the Fed still has the confidence of the markets. That will eventually change as people really perceive the box that the Fed is in, when they ultimately have to acknowledge that it's not about when the Fed's going to hike rates, but about when they're going to launch QE4 and how big it's going to be, and the realization that rates have to stay at zero indefinitely, because the economy is now so addicted and dependent on that cheap money that taking it away will cause a financial crisis worse than 2008. And we know the Fed has no stomach for that. They don't want to allow that type of pain, even if it's constructive long term and necessary for real economic growth. They're in the mode of, we've got to postpone the day of reckoning, even if we end up making the problems that we're afraid to confront worse. And so when the markets figure that out, it's going to put a lot of pressure on the Fed. The dollar's going to cave. Inflation is going to pick up. And then the Fed is going to be caught in a very difficult bind. Does it aggressively raise interest rates, kind of like the Russians had to do recently to defend the ruble? Will the Federal Reserve raise interest rates dramatically and just allow financial institutions to implode, allow massive defaults and bankruptcies, including maybe on the federal level, where the federal government has to, default or restructure its treasury bonds and basically impose haircuts on its creditors, just like Greece did. This is what ultimately awaits the United States. So it's not going to be a pretty picture.
Back in 2008, the Fed managed to, quote, fix the system. What I mean by that is prop the system back up. They dropped interest rates to zero, employed QE, Operation Twist. But what does the Fed's tool chest look like today? Are there any tools left in the chest that they can use if things go haywire right now?
Yeah, well, first of all, the tools that they have don't actually fix the economy. The Fed's tools prevent the market from fixing the economy. They broke the economy, and their tools simply allow them to break it worse, right? And the tools used to consist of interest rates and then quantitative easing, just expanding their balance sheet. The interest rates tool is pretty much gone because, they're at zero. So there's no arrows left in that quiver. So now they're down to just one blunt instrument, which is quantitative easing. They've done it 3 times, and I think they're getting ready to do it a 4th time. And I think they're just going to have to do it bigger. Maybe Paul Krugman is going to be able to convince everybody that the only problem with the stimuli in the past is that it was too timid. It wasn't bold enough and big enough, and we got to go big or go home. And I think it's going to be maybe the final dose of stimulus where we overdose on it and ultimately see a monetary death.
Peter, I want to talk about Russia for a second. It's potentially a contrarian play right now. But what I find funny is the U.S. media's reporting on Russia back last fall when the currency was falling and the interest rates were going ballistic. You had the U.S. media, of course, talking about how stupid Putin was and how the economy was doomed. However, now oil prices are firming up a bit. More importantly, the currency is strengthened and interest rates are starting to be lowered back down. The U.S. media is totally quiet. Nobody's even hearing about Russia. What do you see going on over on that side of the world, and does it interest you from an investment perspective?
Well, I am certainly interested. We don't have a lot of direct investments in Russia, but the emerging markets in general are, lots of values there, and so Russia has helped drag down the sentiment across the region. But yeah, I think that the Russian market is very inexpensive. It's somewhat less inexpensive than it was not too long ago when there was a maximum pessimism on Russia. You even had I think it was the U.S. Secretary of the Treasury came out and said, you got to short Russia. He was actually deliberately trying to talk down the Russian market as, part of the pressure he was trying to bring to bear. But I guess when the U.S. government, when someone from the Obama administration is telling you to short Russia, it's probably a great buy signal. And had anybody bought on the day that those announcements came out, they would be sitting on some nice profits. But yeah, I think oil prices are headed a lot higher. I think oil did bottom out near $42, $43 a barrel. A lot of people are still looking for $20 oil. I don't think they're going to get it. I think oil is more likely to recover back up to $70 to $80 before the end of the year, and then next year back above 100. So. And also, the sentiment is so negative that it really has stopped a lot of the U.S. drilling. And I think if oil prices do come back up, I don't know a lot of that drilling is going to come back so quickly. So our supply is not going to be there as much as it has been in the past. So even though the price of oil goes up, we might have to import more of it, and that just increases our trade deficit. And we'll put more pressure on the dollar. But that'll be good for these commodity-based current countries. And I do think that when the Fed has to come clean about the rate hikes and QE4, the dollar's going to plunge, and that's going to be very bullish for commodities and bullish for emerging markets, which have seen a lot of outflows over the last couple of years as people have been bracing for a tighter Fed. And when they realize they've been preparing for an event that's not going to occur, the Fed is never going to be tight, then the markets are going to be turning on a dime.
How are you and your team playing the oil rebound that could happen, or are you waiting on the sidelines at this point with uncertainty?
No, I mean, we've still been buying more energy-related stocks. A lot of these stocks got beaten down. Many of our favorite names, were basically cut in half along with the oil price. So there's a lot of opportunity there in that sector, and also, again, in the commodity currencies, stocks in Australia, Canada, Norway, those currencies were particularly beaten up because of the fact that these are, big oil exporters, and the idea that this was going to be weak for their economy, and therefore the central banks are going to have to cut rates. And so I think as oil prices recover, that story is going to unravel pretty quickly.
On gold, Peter, I know you've talked about buying this as an insurance product or something that's going to go up when everything else crashes. I want to know what your thought is on shorting the actual general equities. Is that a tool you use, or do you prefer to just go long in assets like gold that probably
I'm not really into short positions, unless you're going to balance your portfolio by shorting certain equities and going long others. You can certainly have an approach where you've got a balanced approach to the market, where maybe you short a weak name in a sector and buy a stronger name or a name that you prefer, so that you're still neutral to market. Because the problem with shorting U.S. stocks is that you're also long the U.S. dollar. Now, I suppose you can overlay your short U.S. stock strategy by being long foreign currency, so you can take the dollar out of it. Because if we have lots of inflation, then you're going to see U.S. stock prices going up. But what I prefer to do is to try to find ways to play the short side of the dollar, which obviously hasn't worked too well for the last couple of years, although it's working well this year. But, going back, the dollar was strong, particularly in the second half of 2014 and early 2015. But I think that's the trade you want to fade. I think there's a lot more profit in shorting the dollar. And another way to do that is you buy foreign stocks, because then those stocks benefit from the weakening dollar, and you get also the appreciation in the stocks. So I do think there's a lot of value in global markets, and I still think that central banks are too easy throughout the world. And as a result of that, inflation is going to be trending higher, and people are going to be looking for ways to protect themselves. And, one of the ways that people do that is by owning equities. And, of course, corporations, one of the ways they benefit from inflation is a lot of corporations have a certain amount of debt. And inflation basically transfers wealth from their creditors to the equity holders. And over time, if there's enough inflation, the bondholders get wiped out, and the equity moves over to the stockholders. So it's a good inflation hedge. And since you need inflation hedges, I like being long foreign equities.
You're notorious for making bold predictions. Of course, we can go back and look at those famous predictions you made leading up to the housing crisis and market crash in 2007. Is 2015 shaping up to be a disaster year, or is that too soon to know at this point?
Well, yeah, 2015 is, not quite half over yet. My guess is that this is not going to be the year when it hits the fan. I do believe, though, that when the Fed doesn't raise interest rates, the dollar will start to decline. But since it had such a big rally, it's got a long way to drop, I think, before it would get into a situation that would cause a potential currency crisis, which is where I think the end game is. But we could have something like that in 2016 or 2017. But I do think the end is near as far as when this crisis is going to occur. But it is certainly possible that something happens in 2015. It's just hard to handicap it, because you've got so many people that have no idea what's going on, and it's just a question of when are they going to open their eyes? When are they going to figure it out? In the housing market, I was criticizing, pointing out the bubble, warning about the implications for years before the thing finally blew up. So you just don't know how long it's going to take. Sometimes the bigger the bubbles are, the longer they can last before people recognize them. And then, eventually when they pop, of course, the bigger they get, the bigger the pop.
All right, last thing I want to talk to you about is Puerto Rico, and we don't have enough time to explain the full advantages here for a U.S. citizen moving to Puerto Rico. But at the conference we just attended, there was big discussion that saving on taxes is one of the best things you can do for your investment portfolio. It's a huge percentage taken from you every year. What can you quickly tell us about Puerto Rico and what you've done?
Well, there's a very unique situation there in Puerto Rico because, Americans are in a very unique and unfortunate situation relative to people in other countries, in that, we're taxed on our worldwide income. Most people, in fact, all other people pretty much on the planet Earth, when they leave their country of citizenship, they leave their tax liabilities behind. I mean, they don't have to file taxes if they're living abroad. So Americans don't have that ability. So you're kind of stuck paying taxes, even if you live in a tax haven where there's no income tax. Well, there's a unique situation now in Puerto Rico, because Puerto Rico has a special relationship with the United States in that by treaty, any American citizens who reside in Puerto Rico, any income that they earn from Puerto Rico is exempt from U.S. taxes. So it's really the only place in the world that an American can go and earn income and not have to cut the U.S. government in on it. And up until 2012, that exemption didn't really help you very much, because Puerto Rico imposed its own income tax based on the U.S. income tax, where the rates were almost as high. And so there was no real big savings, because if you went to Puerto Rico, yes, you got out of the U.S. income tax, but then you got ensnared by the Puerto Rican income tax. Well, Puerto Rico got smart a couple of years ago and decided to use its status to its advantage, and they created two acts, Act 20 and Act 22. One is for businesses and one is for individuals. And basically what those acts do, if you apply for them and move to Puerto Rico, is as an individual, you have no capital gains taxes on any of your transactions that you make, which would include all stocks that you trade, bonds, collectibles, precious metals, works of art. So you can sit in Puerto Rico and trade stocks and assets all you want, and there's no tax on the capital gains. Also, there's no tax on dividends or interest that is generated locally in Puerto Rico. So if you have a bank account, if you have a bond, if you loan somebody money and they pay you interest, there's no tax. For the business, there is a 4% corporate tax, but you can pay out your profits to yourself tax-free because there's no dividend if you earn those profits doing work in Puerto Rico. So in effect, if you move a business to Puerto Rico, you can reduce your effective tax rate to 4% on your earned income and 0% on your capital gains. So it is an ideal situation. It's the best place in the world for an American citizen to live if their primary goal is to avoid taxes, because you avoid a lot of taxes. And obviously you don't have to live there forever. You just, if you just live there for 5 or 10 years, and make a lot of money and save a lot of taxes, once you've saved up enough, you can go wherever you want. You don't have to stay there forever. Although we love Puerto Rico. I think it's a great place to live. It's a great place to retire. So if you're looking for a great climate and you like to play golf and you like the water, it's a nice place to be, and it's not far away from the U.S. Most of the time it's on the same time zone as the East Coast, about a 3-hour flight from New York. So it's a convenient place to go. I put together a video with Doug Casey. If anybody wants to check it out, they can go to ustaxfreezone.com, and they can get a little more information. It's a free video, ustaxfreezone.com, and just check it out. In fact, let me just actually, is it U.S. tax free or just tax free? I forget.
I will post the link to that video. I've seen that video in the past, and it explains everything you just went over in great detail in 30 minutes.
Yeah, and sure, too, if people want to get more information on our strategies, they can come to my website, europac.com. We do have some special reports that people can download, one in particular, Tax by Debt, another one, The Powerful Case for Investing in Global Equities, kind of go over my strategy, how to avoid the inflation tax, and how to diversify by investing internationally. So all that stuff is available at europac.com.
Great, europac.com. Peter Schiff, everyone. Thanks so much, Peter.
Okay, take care.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen? Or are you too stupid?